Good afternoon. This is Tracy Swenson again with Primatics. Thank you for joining this afternoon's webinar. Before we dive right into the topic at hand, I did just want to go through a few administrative items before we get started. So regarding questions, just because of the large amount of attendees on the call, we do have you all muted upon entry, so you won't be able to speak up until we turn that off. What we will do is have a period of 10 minutes or so at the end that we will reserve for questions, and we will unmute everyone and open up the line so that you can ask the presenters any questions you may have. In the meantime, if you don't want to forget a question, you are welcome to type it into the chat and send it to us, the host or panelists. We'll be able to see those. Otherwise, we will get to all the questions at the end of the WebEx. Anyone who on the line is also interested in CPE credits, I'd just like to make a quick note that in order to receive the CPE certificate for today's event, you do have to remain on the call for the entire portion of the webinar, complete the polling questions throughout, and the survey at the end. There is one particular question, the last question on the survey, that asks if you need a certificate emailed to you. So those are the important pieces that we need in order to provide that certificate to you. All right. Without further ado, we'll get things started here. I'd like to first off introduce our speaker for today. So John Lankinow, he is the VP of Product Management here at Primatics Financial. He heads up pretty much all of the valuation and accounting capabilities and operations within the Evolve system that we provide. And he is essentially kind of our expert here in the field. He has extensive experience in the financial services industry. We could probably go on and on about where he's come from, and I'll let him maybe mention that as he goes through some of his commentary through the slide. But without further ado, I will hand it over to John to kick off the topic of stress testing.
Thank you, Tracy. If anybody can't hear me, just shoot us a little note, and I will move closer and speak louder. Good afternoon, everybody on the East Coast and Central Coast. Tracy was a little bit discriminatory to our friends on the West Coast, and I think we have some folks here from Hawaii. Good morning to you all. I'm pleased to see the turnout here. We've got more than 30 people at last count, mostly from banks between 10 and 50 billion. We also have some folks representing institutions who I presume hope to be greater than 10 billion soon, and we even have a couple regulators. So welcome, everybody. The agenda is going to be primarily useful for institutions facing Dodd-Frank stress testing for the first time, namely folks between 10 and 50 billion. But I think it'll be generally useful to banks who hope to cross that threshold, as there are some expectations as you get near it about what you're going to be able to be prepared to do. I will just talk for a minute or two in general to put the exercise in context, but mostly I'm going to talk about how to approach the stress test and some lessons learned from institutions who've been through the process before. And the final section will be a demonstration of the Evolve platform by my colleague Eric Wazorko. So stress testing as an exercise has been around a long time. In the current form, though, it's really only about 4 or 5 years old, and it was really driven by the response to the financial crisis of 2008. If you can put yourself back in the mindset of that time, there was a lot of concern about the U.S. financial markets, and the regulators stepped in very aggressively and I think very admirably to try to calm the markets. And one of the big exercises was the SCAP, the Supervisory Capital Assessment Program, where the regulators themselves went in and performed an assessment of the capital adequacy of the very biggest banks to withstand another severely adverse scenario. And this actually led to mandated capital raises, fairly significant ones. Continuing on from that exercise, there were various regulations promulgated, and we got to the CCAR, which is Comprehensive Capital Plan Review, and CAPR, Capital Plan Review, which is the way I think about it, just CCAR light for institutions that are a little bit smaller than the CCAR banks, but they are converging this year. And really, this was a review of the capital plan. It was more than a stress test. It was It includes a stress test, but it was also trying to make sure that the biggest banks, the ones that could really cause a lot of trouble to the financial system if they failed, were able to withstand another severely adverse macroeconomy. And then the regulators weren't the only people with power in Washington who learned lessons from the financial crisis. Congress also learned a lesson, and as everybody knows, Dodd-Frank was passed. As part of Dodd-Frank, there is a stress test that has to be done. So for the biggest banks, the ones who are subject to the CCAR and CAPR, Dodd-Frank is really just a part of that. The regulators have also done a very nice job of minimizing the burden to the extent possible of having to do extra stress tests. So the Dodd-Frank results look a lot like the CCAR results that the biggest banks have to produce. Now, the banks between 10 or institutions between 10 and 50 billion didn't have to do it last year, but this year it's your turn. And so the rest of this webinar is going to be about how you can think about it and how you can approach it. So also, as part of the regulatory pronouncements the last couple of years, there have been some definitional things, and it's always useful to start making sure everybody's on the same page. There's nothing terribly surprising about this definition. It just says it's forward-looking, that's important, and the events that you're looking at are adverse. So in the way I say it when I'm talking to my wife is I say all stress testing is what if something bad happens, what happens to an institution? So that's stress testing. Now, Congress also, in Dodd-Frank, told the regulators to define a stress test. And in later slides, I will put the term stress test in quotation marks when I'm referring to this definition, because this is the definition that's going to be most applicable to the Dodd-Frank activity. So it's a process to assess the impact of economic and financial conditions. So it just says you're going to have some macroeconomic scenarios. And then I have this in bold because I think this is a really important point. It's on the consolidated earnings, losses, and capital of a company. It can be a little subtle, but really it's saying you need to do a GAAP view, and the GAAP view then flows through your balance sheet and informs your assessment of your forecast capital. So that's an extension outside of the historical exercise that people have done in terms of stress testing. Over a set planning horizon just means you don't have to look for infinity. You only have to look a couple years out, 9 quarters. Taking into account the current condition of the company, it makes sense. How much capital do you have now? Where are you placed? And things, what are you exposed to? What are your strategies? What are your activities? Embedded in this last sentence is also some nuance that isn't entirely clear when you look at the Dodd-Frank templates that have to be filled out. The business strategy, so if you plan on buying a bank, it's part of your capital plan. That really ought to probably be part of your stress test. New originations of loans should be part of your stress test. If you're planning on selling loans, that should also be part of your stress test. All the things that you're planning on doing should be part of the stress test. And just to emphasize, the accounting view has become it's a necessary component for stress testing for banks of greater than $10 billion. And I think now we have our very first polling question.
We have our first polling question here. Just take a quick moment to respond to this. We're really just looking to understand, what your particular institution has done to prepare for the Dodd-Frank stress test. You can check one, you can check all that apply, but we're curious to see is it, that a cross-functional working group is created, that there are separate groups responsible, and they're just merging some of that information. Did you turn to advisors or new technology or possibly even new models? And then certainly, if you haven't really taken any action yet, or if you don't plan to take any action because you aren't subject to Dodd-Frank, those are options as well.
Okay, while folks are finishing up this polling question, I'll keep going, and we will circle back to the answers after the next slide. There's a spectrum of stress testing in terms of the level of complexity that faces banks. And for the very biggest institutions, obviously it's the most complex. And as an institution gets bigger, no matter where you are in terms of regulatory requirements, it gets a little bit more complex. So, for example, both, say, a bank like PNC and JP Morgan Chase have the same regulatory regime, but clearly PNC's exercises are a little bit less complex than JP Morgan's. And then there's also an increase in complexity as you approach a regulatory threshold. So, for example, a bank of perhaps $45 billion or a bank of $7 billion that's intent on doing an acquisition will have to show its regulators that it expects that it will be able to meet the regulatory expectations of the next level of stress testing. It's something that is a important thing to be able to do to go to the next level. And then if you're under 10 and not in an acquisition mode, the expectations, there's just general requirements. There isn't a requirement that you do an annual stress test or anything like that. But all institutions, regardless of their size, are expected to be able to look at the impact of adverse events on their bank. And so this is kind of a way of thinking about it in terms of complexity. And many of you are in that middle range now. And if you're not in the middle range, you're going to be getting in the middle range. And as you think about crossing 10 billion, or as you think about crossing 50 billion, it's very much worth looking at the expectations of the next level up, because the regulators are going to expect that you can do that. Are we done with the? Okay, so I think we're going to push the answers to the polling questions.
All right. I think they're giving kind of a last few seconds for folks to respond. But as you'll see, it's looking like the majority of the group has opted for B.
Okay, so that's very interesting. I think that shows that some institutions have already learned one of the big lessons from the institutions who've done this before, in the sense that they've created a separate group to do the exercise. I would probably call that a best practice, just because an ad hoc cross-functional group, while it brings together the right resources, also tends to view this as more of a project instead of a process. And in order to be successful over and over again, this exercise needs to be a process, not an ad hoc project. Okay, so moving to the specifics, I think most folks already have looked at these and know what to do, but in case you haven't, you need a GAAP-compliant income statement for the base and 2 adverse scenarios for 9 quarters. And this is both for the OCC form and for the Fed template. And again, I would give credit to the regulators for cooperating on this. Both templates, although not exactly identical, are extremely close, and I think that's something that a lot of banks were worried about before this happened, is the extent that the regulators would be cooperating, and we've been very pleased that they have done a very nice job on that. So you need a GAAP-compliant income statement and balance sheet, and then those drive capital ratios, and there also is a qualitative report that discusses what you did and explains the most significant changes that you've seen in your results. So we've worked with a lot of the very biggest banks who've done this before, and I've talked to the majority of them, even the ones we haven't worked with, and we've seen a lot of common pain points. And the very biggest pain point is data. Data is always a challenge for any new process. They live where they've been historically needed. So this new process puts a lot of stress on existing systems. And we have our second polling question coming in terms of the data.
So in terms of the data, we're curious to know, is there a particular loan product type that you anticipate will cause the biggest challenge for your particular institution? For those of you not subject to the requirement, feel free to play along with us and answer as if you would be subject to it. Your options obviously include commercial, residential, consumer, or maybe you're not concerned about a particular type, but rather acquired loans that you have, versus a final answer could be that you just don't anticipate any data challenges.
Okay, so while people are finishing the question on this one, I'll move on to the next pain points we've seen. The other one, big one, has been integration. Historically, and I'll get more into this on future slides, the valuation and the accounting views of the world have lived in separate silos, and that was a big challenge for some of the banks that have had to do this exercise before. Getting the results accumulated and interpreted and placed in a way that everybody can understand what they are has been a challenge. And again, it's a new business process, so that makes sense that this would be a challenge. And then generating GAAP compliant forecasted results. Doing the accounting has been a challenge, and I'll get a little bit more into detail on the next slide on that one. And finally, we call it struggle for growth, but it's really about making the process efficient. It's not a project, it's a process, and it's a process where you're expected to get better at every year. So some of the lessons we've learned from that is the biggest banks started out as a project, then turned into an inefficient process, and are spending a lot of resources and time to try to make it a more efficient process. An example of the coordination difficulty that we've seen is you have three groups that have to coordinate to perform a capital adequacy stress test. You have accounting, credit, and forecasting. And most accountants are comfortable with actual events on actual loans. And in this exercise, you have to do forecast events on loans that don't exist. And then credit and forecasting have to get their views of the world in sync, and that's been a challenge because the forecasting group has tended not to generally coordinate with the credit group. And the forecast group also has not generally done a lot of performance of stressed macroeconomies into account when it's doing its forecasting of actual balances. And so getting all these groups on the same page in an efficient way was a major challenge. And for the first couple of years, frankly, most banks did not do that very well. There was a lot of iteration between the forecasting and credit views of the world to try to make sure everybody agreed that the balances and the loan performances were okay. Okay, so we have actually the results of the data poll. I think we're going to push that out. Okay, so it looks like the plurality says that the commercial loans would cause the biggest trouble. I think that is consistent with expectations. Residential loans have solved the data problem to a greater extent years ago in terms of creating fields and integrating. Where a lot of commercial loans, oftentimes the origination system and the risk management system and the servicing system are not talking to each other terrifically well. So that will be a challenge that has to be overcome in order to do the stress testing going forward. Again, not a surprising answer. Okay, so the Dodd-Frank templates have a bunch of things that have to be filled in, and there's really only about 10 categories. And I've listed them not because I feel like it's useful to go through them, but I'm going to categorize them into even smaller categories based on the approach that makes the most efficient sense in terms of a bank filling them out. So for an income statement, there's certain items that are going to be relatively less complex than others, and those are going to be items that aren't necessarily credit sensitive, and they aren't going to be interest sensitive. They're going to be, some of your non-interest income items where it might be, estate income or miscellaneous fees, where you might have a relationship to something, but there's really not going to be a way of solving it that's going to be in a standard system. It's going to be spreadsheets and people, no matter how you think about it. Then the next set of items are getting more complex, but they're still not the most complex. And these are going to be items that are interest sensitive. And when you think of interest sensitive, you should think about ALM, and that's the right place to solve for some of these items. You have, for example, Fannie Mae securities or Freddie Mac securities. Those aren't going to have a lot of credit sensitivity, one hopes, but they definitely have interest rate sensitivity. So you'll want to use your ALM system, which probably already does some sensitivities on these in the normal course of business. You can leverage that for doing that for the stress test. Now there's the most complex items, and it's items that are going to be credit sensitive and interest rate sensitive. A lot of times that's going to be your loan book. And for the loan book, it makes the most sense efficiency-wise to use a specialized solution for that. And moving to the balance sheet, you get the same types of complexity for the same types of instruments, same way of thinking about it in terms of being efficient at it. And again, this just shows the primary way of doing it in the most efficient way. You could possibly do everything in spreadsheets, and we saw some CCAR banks do that, or a very, very close to that exercise in the first year they did it. But they've evolved in the process. That was really not a very good way of doing it. An army of people with spreadsheets is not an efficient way of getting good results. And so the banks who've done that, and even the banks who started off in a little bit more advanced position, are either buying or building specialized tools to make the process more efficient, because it's not going to become, the pressure isn't going to be let off until everybody is able to do this as a normal business process. Okay, so it may seem obvious, but a stress test requires evaluating the impact of adverse conditions on loan performance. I mean, a stress test requires stressing loans. And a key question to answer is, how can you do this? Now, roll rates are often in institutions already of various sizes, but this isn't sufficient, even for the base scenario. It's not really a model. A roll rate is based on a backwards-looking view. It usually comes from FAS 5, which explicitly says not to look at the future, and a stress test explicitly says that you have to look at the future. So it's a different exercise. So maybe the answer is adjusting roll rates. If you do that using management intuition, that is also not sufficient. It's difficult to validate that. You can't defend it. You could potentially build a robust statistical model that adjusts your roll rates, but such a model is quite a challenge to build. It's very time-consuming, costs a lot of money, and then you have to validate it and maintain it once you've built it. So that's probably not the best solution. So I think we have our fourth polling question.
I think
okay.
This is actually our third polling question, so we'll open this up to the group. And the question really here is, as we talk about forward-looking models, how comfortable is your institution with your current forward-looking models or capabilities for modeling loan behavior in, this type of stress scenario? So, are you very comfortable? Are you somewhat comfortable? Or are you not comfortable at all?
Okay, so we're done with that question, or mostly done. Tracy, you want to push the results?
Sure. It's looking like the final ones are coming in, but really what's taking the lead is B. People are feeling somewhat comfortable.
Yeah. Okay. I think that also makes sense. So different parts of institutions have had different exposure to models historically. Okay. So there's two different kinds of modeling approaches that can be used. You have top-down, which is really done at a high level, so it's a portfolio or asset class. and bottom up, which is really a detailed level, loan level build-up. The top-down can be pushed down to more granular levels. And I would say that just because top-down is simpler, it doesn't mean it's worse. I have talked to some very large institutions who, in their normal course of business, use top-down models for loss forecasting, conditional and macroeconomic forecasts, because it's the most accurate. They also have a loan-level model that they compare it to, and historically the top-down model has been better. And then when they want to get more insight into specific corners of the portfolio, they calibrate the loan-level model to the top-down model. So loan-level models give you a little bit different ability to get more granular in terms of your analysis, and top-down is a little bit simpler and gives you a broader answer. I've seen some CCAR banks, for some portions of their book for the CCAR exercise, still leverage top-down for the exercise. So it's not that it's something that is just because it's simple, not useful. I would say, though, as you get bigger, the modeling demands will increase, and for some asset classes, especially mortgages, it's going to probably be better to have more granular models, mostly due to the prepayment risk of the asset. So it's also, there's an important point here in terms of how to apply models in a Dodd-Frank stress test. And I love this graphic. It's quite dramatic, but it basically says, and it sounds obvious again, but all loans must be stressed. You know, whatever kind of models you use, you're going to be given a national macroeconomic scenario, and it's going to be tempting to say, I've got a book that may not be sensitive to national macroeconomic views, and I've got a book that's more sensitive, and stress them a little bit differently. And I think the question you're going to ask if you do such a thing is, how can you defend why the book you say is going to perform better is really better in any general national macroeconomic scenario? It's not an exercise of risk management to try to figure out, you know, do you have the right concentration, or do you have undue exposure to a certain geography? This exercise is to make sure that if the national economy goes bad for an unspecified reason, that you have enough capital. And that shouldn't be confused with thinking about more detailed risk management questions, where maybe you're a bank in Ohio and you've got exposure to the Michigan auto industry and the Ohio energy industry and the Indiana agriculture industry. Those are very different books of business. And if you're thinking about risk managing, you're going to want to create a scenario where you say the national macroeconomy went bad because energy prices were really high. Well, that will probably kill your agriculture and kill your auto loans, but it'll be very good for your energy loans. So you'll want to examine different kinds of stories. But for the big Dodd-Frank story, you want everybody to get killed. All loans should be bad. Looking back at the particular history of the region can be a little misleading. For example, my county had very low house price declines in the crisis. But that doesn't mean that a bank that's located near me can look at a national house price decline in a stress scenario and say, I don't have to worry about it because in the last time house prices declined, they didn't decline in our area, so we're not exposed to that. That's precisely the opposite of what's expected in the exercise. You have to be thinking that you are going to be exposed to that, and all your books have to get stressed accordingly. So for some more details in terms of being prepared and how to approach some of the complex items, I'm going to turn it over to my colleague, Eric Wazarko. Thank you for your time, and I will be back in 20 minutes or so to answer some questions.
Thank you, John. So to summarize and transition into our product demo that we're going to provide here, you know, there are aspects of the stress test process that are relatively easy to do, and there are, you know, certainly spreadsheet processes and ALM tools that can do that. But there are other components that are much more complex, and we have some solutions that I'm going to show you here in a few minutes that can solve for that. And what we're working on with a number of banks is to do a dry run, and this is basically a one-time effort. We can do this in 4 to 6 weeks, but it's a one-time effort to stress your portfolio, bring all the loans onto our platform, run them through our models, and generate the required output in terms of your forecasted balance sheets and income statements that are going to be required for the stress test. And that's what I'm going to go through here is some of the capabilities that we offer in that space. So I'm just going to log into the demo. And the first thing that we're going to do is we're going to go into the valuation area. And you'll notice here that we've got a number of different scenarios that have been set up on the system. And so we've got, you know, a severe downturn, a base case, economic recovery, and these are all different scenarios that we're going to model on the loan portfolio. And we're able to do the modeling, generate your expected loss in each scenario, and then convert that into your forecasted accounting. And so what I'm going to do is drill into this one here called base case by call report to give you an idea of how we actually do the modeling. And so what we've got here is the ability to segment your portfolio into different cohorts. In this case, and a cohort is just a way to group the loans into segments to model behavior. In this case, we've cohorted the loans based on call report categories or product types, but you could really pick any attribute on the loan to model behavior on. We have the ability for each cohort, you can select a model, a set of macroeconomic assumptions, and shock assumptions if you are going to do a shock scenario. So if this was a severe downturn, then we would have a set of shock assumptions applied as well. So once we set up the model and we run the model, then we come up with a set of reports. And I'm really going to focus here on the reporting capabilities that we have in the system. So we have a number of reports that are going to be generated as a result of running all the loans through the platform. And the first one we're going to drill into here is what we call a valuation results summary. And what we're able to do here is compare two scenarios or two runs against each other. So I'm going to pick the base scenario, and the second run that I'm going to pick is going to be a mild downturn scenario. And so we're able to take these two runs and look at, okay, how do the results compare against each other? In this case, we also have the ability to load in discount rate scenarios, and so I've got a mild downturn and a base discount rate. And when we run this comparison, you can see here a summary of the valuation results for those scenarios. So we've got the mild downturn. You can see for each of your portfolios what's the gross cash flow. We've got the mild downturn and the base, and then down below is the difference. So you can see in this case, the mild downturn generates an NPV of 8.5 million lower in NPV beyond what the base case offered. Again, there's some other interesting data here around defaults, prepay. All of that data is then available to drill down to a more granular level. So here I could drill into this commercial real estate portfolio, and I could even drill down to a loan level. So I can bring up the cash flow instrument, and now we're looking at loan level data within the CRE pool. So you could see, and again, we're looking at loans that have a significant difference between the base case and the mild downturn. You can see which loans in the portfolio are driving that difference. So we've got a few loans here that reacted much differently between the two scenarios, and they're driving the change in cash flows and the change in NPV. So a large majority of your increased losses is based on these few loans here. So that's some of the valuation data that we're able to generate. And so once we've done the modeling and come up with the valuation information, we're able to drill into some of the accounting reporting. And I've got a number of reports that we're going to walk through here, but the first one is going to be this aggregate interest income forecast. And again, what you'll see here is we've got multiple different scenarios. We've got a base scenario, severe downturn, economic recovery, and we've got each of the different components of the interest income forecast. And we're forecasting this out across multiple quarters. For the regulatory CCAR and DFAST perspective, you know, the 9-quarter forecast is what's required. And we've got each of the different components of interest income here. So if you have a lot of acquired purchase credit impaired loans, you'd see a row for that as well. And then you've got your performing loans, straight line amortization. So all of the different methods of interest income are captured in this report. And what you can see is for the severe downturn, much lower income going forward than the other scenarios. A couple other reports that we have here that are going to be useful is we have the ability to look at expected provision. So I'm going to jump down to our expected provision forecast. And again, looking at your different scenarios, this provides a beginning impairment balance, gross impairment, and then you can see your expected provision expense. And again, in the severe downturn, much higher expected provision expense than you would see in some of the other scenarios. Okay, and then you get to an ending impairment balance. So this is essentially a roll forward from your beginning balance to your ending balance. We've also got an aggregate provision forecast, and it's going to have basically, again, a roll forward view. We're looking at here at the severe downturn scenario. So in this case, I've got your general reserve, the specific reserve, and then your complete ALLL view. So for each of those components, we do a roll forward with your beginning balance charge-offs, NAD adjustment, and then finally getting to an ending balance. So we bring together here, your FAS 5 and your specific reserve components to give you a complete ALLL forecast and roll forward on that. And the last report that I'm going to show is a view into the balance roll forwards. And again, this is another one of the requirements of the submissions. So here we're looking at, again, for each quarter going forward, your beginning balance, new originations, pay downs, purchases, and sales to getting you to an ending balance. And if you are forecasting new business, then you would see that new business forecast show up in this line here. If you're forecasting management actions such as purchasing assets, maybe making acquisitions or selling assets, then you would see those management actions that are modeled would be showing up here as well. So with that, I am finished with the demo, and what we're going to do now is open the floor up for questions. So if you have any questions, feel free to send them in, and I think Tracy may have a couple questions already.
So we have a question here that says, first they recognize that we are demoing our solution, but they ask about what have we seen in some institutions using in order to ensure a sustainable process versus a project approach. Vendor application, leveraging existing models, or building something. And I speaking generally, I think the answer is we've seen all of those things, and some of it depends on the level of resources an institution has and its culture. There are some of the big banks, especially, that very much like to build everything. And so even if there are parallel systems, ours or somebody else's, that can do the same thing, they will build. And I've even seen institutions build the same process in a CCAR engine that they have as a business as usual. They've built a complete replica of a business as usual process in the engine. I think the better answer to that is I would start with a kind of gap analysis. I would go from the Dodd-Frank templates and line by line just look at each item and say, how can I solve this item in the most efficient way, given all the other, given what I have now and what the resources and systems and expertise I have here in the bank have. One thing I would say is there is no silver bullet. If somebody ever invents it, it will be solve all of the stress testing problems.
And just know that all the attendees are unmuted now, so if you don't have a question, feel free to mute yourself. If you do have a question, we are taking those.
So here's another question. Do you adjust the algorithm of your model for each institution? That's a good question. So for a top-down approach, there are also different flavors of top-down. You can do a top-down approach using kind of national level models built on all institutions. You can build it on national level models that go to institutions of a certain size, or you could build it based on some regional institutions. We do not do a specific institution by institution model. I don't think that most institutions have enough loss data through a credit cycle to justify them like that. But we would take existing algorithms that are higher than an institution level and make sure that they make sense to the institution. So I would also say that a model is a starting point. So you put a model in because it's the most efficient way, and then you look at it and make sure you like the results.
Yeah, I have a talk.
It makes sense to you.
I forget. We really.
We have, John, how about this question? What data is required in the loan system?
The data required in the loan system, since we're doing cash flows, so we can do interest income. We need data sufficient to generate contractual cash flows, and that can be simple for some assets, a little bit less simple for others, or we can work to do assumptions where some of those data are more complicated to get than others. And then, since we're doing accounting, we need things like the recorded investment and some of the, net unamortized fees and things like that, and charge-off. So, not a huge amount of data for most loans. For acquired loans, like PCI loans, you need a little bit more. But I think it's broadly just enough to do contractual cash flows plus an accounting field or two is sufficient.
Okay, great. Why can't an ALM system?
Oh, okay. So just going back to that, that is a very good question. A lot of institutions the biggest institutions think that or thought that the first couple times. Historically, it worked okay, but they had to build a lot of manual processes on the front end and on the back end. The ALM system is designed to do interest rate sensitivity, not credit sensitivity, and it's not necessarily designed to do GAAP accounting. So in order to make that system do credit sensitivity and GAAP accounting required manual processes on the front end and the back end. It was doable, but it was a lot of work, and most of the institutions that I've seen who started with that approach have pared it down and are using the ALM for the things that the ALM is best at, and for the systems that ALM, for the balance sheet items ALM is not traditionally that good at, they have switched to another system, either buying one or building their own.
Any other questions from the crowd? We're just asking that you type in your question into the Q&A section, but I think we do have one final question coming in. In reference to complexity, have you heard anything that documents the level from, say, a 10 billion asset size bank to what a 40 billion size bank would require?
So yeah, he's referring to the complexity curve I showed, where it says it gets more complex, and there's two components to that. One is it gets more complex because you enter a different regulatory regime. Second is it gets more complex because you have a more complex institution. And then there is probably a third category that the question refers to is an expectation different for a bank that is just over the threshold to one that is closer to maybe not quite at the level of the next threshold, but close enough to it. There's not going to be anything that comes officially from anybody saying that, but there is a very big difference between a $10 billion institution and a $40 billion institution in terms of the level of resources available and the ability to scale some of that. It doesn't take 4 times as much effort to manage a book that's a residential book, for example, that's 4 times as big. There's a lot of economies of scale there. So short answer is no, nobody has said anything. I would expect the $40 billion bank they would start expecting a little bit more because it would be realistic that you could become 50 relatively soon. But if you weren't in a big growth mode and you weren't doing any acquisitions, I don't think anybody knows the answer to the 10 to 40 yet. In terms of that, I will certainly let you guys know when I hear about it, next spring. But right now, if you ask a regulator, they're going to say the rule says everybody has the same expectations, and we'll see how that goes in practice.
We did get another question in here, John. Can you speak to how you validate your models?
Yeah, so originally, long time ago, way back in the early 2000s, when OCC 2016 first came out, I was at a group at PwC that specialized in model risk management and helping banks figure out how to validate their models and build model risk management practices. So I brought that experience with me here to the models that we've built ourselves. We have hired an independent validator and have given her the mandate to validate our models according to the regulations. Here's our models, here's how we did it, here's the data, here's the assumptions, here's all that stuff. Write a report, and we share that report with our clients to help them with their internal model groups, to help them with auditors, to help them with regulators. I know that building models for both business and accounting use and for regulatory use is very serious, and we manage and document those accordingly. And we're always available when there are questions about models that documentation has not answered to make sure that everybody's comfortable with what we're doing.
Okay, great. Well, I think that's it for questions, and I think we're also up on time. So should you have any additional questions that you'd like to get to John or Eric, please feel free to send them our way. We're happy to get it to them directly or put you two in touch. As I did mention, the recording will be made available. We can share that with you next week. We'll also make it available on our website. If you are interested in CPE credits, again, complete the end of the webinar survey and just note in the question if you need a certificate that, yes, you'd like us to follow up with that information. So again, thank you for joining our webinar today, and we look forward to seeing you at future events.